Great to have you with us. I think this is one of the more eagerly awaited budgets that we've had in the recent past, given the dilemmas that the country faces, and particularly the monkey on all of our backs being Eskom. And we were looking forward to seeing what government had in store as far as plans to fix Eskom. And I must say, given the circumstances, given the country's economic situation, and really difficult times all around, I think we can be very happy with the outcome of this budget. So I was relieved after having gone through the content. I think it's a good budget. And really lots to be pleased with, lots to be thankful for, but certainly lots of challenges in store. So great to have you all. And my name's Schulze. I'm the CEO and tax service line leader of RSM South Africa. And I'm joined by Chris Axelson. And Chris is the Chief Director, Economic Tax Analysis at National Treasury of South Africa. And I must say, Chris, you must be breathing a sigh of relief that this process is behind you. And in fact, what I'll do is give you a brief introduction to Chris and let him say a few words before we kick off. So. Chris worked previously at HMRC, that's the tax authority in the UK. And I'm not sure whether that's Her Majesty's Revenue and Customs these days, or whether that's changed to His Majesty. Chris then also has worked at Deutsche Bank and Genesis Analytics in a variety of roles. He holds an MCom in Economic Sciences from WITS and is a CFA charter holder. And sources close to Chris tell me that he's a keen golfer and a lover of cricket. So, Chris, you must be excited for the semis of the T20 Women's World Cup coming up. But Chris, so if you want to unmute and just show us your face quickly and tell us how you feel after this last couple of days and months building up to the budget.
Yes. Thanks, Dieter. Can you hear me?
Yes, loud and clear.
Okay, good. No, thanks. Thanks very much. And thanks for the introduction. Yes, it's been quite a ride. These budgets are always quite difficult. This is my 10th budget in a row, and they never seem to get easier. Although sometimes we have a bit more revenue and sometimes we have a bit less, which does make some of the stresses lower a little bit if there's more revenue. But it's still difficult. There's lots of difficult decisions to make, lots of things to put together. So yes, quite glad it's done, although it's certainly done, but now we have to do a lot of explaining and a lot of defending and a lot of engagements with stakeholders and society and parliament. So a lot of the work really starts now as well. But thanks again for having me, and thanks for the intro.
Great, Chris, thanks. And I must say it's one of those encouraging signs when you look at the work that National Treasury are doing and the work that SARS is finally back and doing. I'm quite optimistic as far as those two spheres or departments in government. I just wish you guys could get the rest of the government on track. And I suppose that's partly your role over the course of the next while. So I think just moving on then, just as far as the order of events for the morning, I'm going to kick off and just share a little bit on some of the statistics around the budget, very high level, and then go into the tax proposals, tax rate changes, etc. And then some of the other highlights coming through. And then I'm going to pass over to Chris, who can take us through his perspective and some content coming through from the budget. And then we'll open up the conversation more broadly And please feel free to post any questions in the chat or on the Q&A, and we'll try our best to deal with those. Okay, so moving on to statistics and tax proposals, and just looking at the revenue projections for the period 2022-2023. And of course, we haven't reached there yet, but the period ends 31 March. So of course, these are still projections. But what is interesting to see is that SARS has continued to collect more than the budgeted revenue. And this has been a theme now for a couple of years. And I think Chris will probably take us through in a little bit more detail as far as the reasons for that. But really, we're benefiting from the commodity boom. It's mining companies that are really contributing their taxes as a result of the profits that they're making. So a number of reasons for that. And I think also coming out of COVID, the Treasury have probably set a reasonably conservative budget, and quite rightly too. And we're seeing that those targets are being met and some. And if you have a look at the slide in front of you, you see the extent of the beat on projected revenues from the 2022 budget last year. So last year we projected almost 1.6 trillion rand in tax revenues. At the medium-term budget in November last year, that target was increased because we knew we'd beaten it by 83 billion rand to 1.681 trillion. And now we see a further improvement of 11 billion rand and targeted revenue collections of 1.692 for the 23 financial year. So that's good news that SARS is beating their targets in terms of collections. But you can see the theme here is that the beat is slowing down. And really, the commodity cycle has kind of come to an end. Those massive profits that our mining companies are making, those have been kind of built into the projections. So we see that beat becoming harder and harder. And if you have a look at the analysis of where that improvement arose, in the bottom table there, you'll see corporate income tax, 75 billion. Personal income tax, there was a beat there too. That we were in fact under on projections. Fuel levy the same. If you recall, we got a holiday on fuel levies during the latter half of last year. So that's a reason for the shortfall there. Dividends tax contributed somewhat, and then customs duties as well. So a total beat of 94 billion rand for the year. And that's great news. And, also means that SARS is doing their job well. So we're seeing the process and that administration improving. So good news as far as those numbers go. What is always interesting, just to touch on, is that 1.692 trillion that we project to collect. Where does it come from? And really, personal income taxes is by far the biggest contributor there. And 35.6%, 602 billion rand projected to come from UNI. And then, of course, the VAT also contributed by UNI makes up the next largest piece of the cake at 25.2%, 426 billion rand. And often surprising to some of us is the corporate income tax portion of contribution at only 20%. So relatively low contribution in total. And that percentage has stayed fairly consistent for a number of years. And then if you look at the rest of the contributors, fuel levies, customs duties, excise taxes, dividends tax, transfer duties, skills development levies, and then other. So just an interesting stat that as far as where the taxes are collected and the source of those. Then moving on and having a look at the changes around personal income tax, and just kind of bear in mind that these changes, we've already seen the draft bill come out to affect the changes in rates, the changes in the tables, and that is promulgated quite quickly, and these are effective essentially or mostly from 1 March 2023. And so that's the 2024 tax year we're dealing with. It's really the other proposals that are still waiting in the wings, and those we'll deal with a bit later. But those proposals are certainly not cast in stone. There's still a lot of consultation that takes place. So what we're seeing really are proposals. A lot of those will come through, but might come through in a different form, changes and tweaks, etc., after the consultation process. So let's start with our personal income taxes and where those thresholds have moved. Essentially, the brackets or the tax table the format has stayed the same. So the number of bands has stayed the same. The brackets have been adjusted to compensate for fiscal drag, as they say. So those of us that are receiving salary increases to keep in line with inflation, we'll see those bands adjusted by 5% for the 2024 year. So that's good news. Not quite meeting inflation. What are we projecting? 6.9 at the moment. Probably during the course of the latter or second half of this, the 2024 year, we should see that number start coming down. So 5% across the board there, relief is certainly welcomed. So what does that mean? And then moving on to the rebates for natural persons, we also see an increase coming through there. And on the primary, secondary, and tertiary rebates, we see about a 4.9% increase coming through there. So around the 5% theme carrying through. And what those rebates translate into is the tax threshold. And that's the amount that you can earn before you start paying income tax. And taxpayers aged below 65 see a 4.9% increase coming through to 95,750 Rand. Age 65 and over, 148,217, and age 75 and over, 165,689. So welcome relief there and some increases. The marginal tax rate is still at 45%, no change, and that rate kicks in at a taxable income or taxable incomes above 1.817 million Rand. We also see some increases coming through in the range of 5% on the monthly medical tax credits. That's the Section 6 Cap A credit. And thank goodness, no change in the inclusion rate for CGT purposes. That still sits at 40%. And the annual interest exemption limits stay the same. And we've been told that those won't change. If you recall, the tax-free savings accounts were introduced, and the idea was to replace these interest exemptions, but those were left in place, and over time, with inflation, essentially will become meaningless, I suppose, because those will not increase. Then, moving on to another statistic coming out of the budget, and that is who is contributing that personal income tax. And the analysis here on this table breaks down the number of registered taxpayers in that second column. And you see there the grand total of 14.6 million people. These are individuals now. And of those, 7.5 million don't pay tax. And really the reason they're registered is because employers are obliged to register them when they take them onto the payroll. So half the registered taxpayers don't pay tax, and then the rest are split according to their taxable income level. And if you have a look, by far the majority of our tax, and the quantum is in that fourth column versus the number of taxpayers in the second column. And quite interesting to see who's contributing the most in amount of tax and the number of taxpayers that make that contribution. So just a point to note here is if you have a look at those earning above 1.5 million rand a year, 163,000 of them in the country, and they contribute 193 billion in tax revenue of that total, 190 billion of the total 640 that is anticipated. So just an interesting statistics there, or stat to see who's contributing most and who's contributing what at what level of income. Then moving on to retirement fund lump sum benefits, and I must say this is a bugbear of mine. I can't remember when last this table was changed. Certainly not for the last 10 years. And we now finally see an increase in the thresholds. And we've seen a 10% increase come through on the lump sum retirement table and the lump sum withdrawal table. And that is most welcome, I must say, but certainly doesn't make up for the lack of increase coming through in the previous many years, but I'll take it. So if we look at the threshold you can take out of your retirement funds on retirement before paying tax, that's increased from 500,000 to 550,000. And then you start paying the maximum marginal rate of tax on your retirement lump sum of 36% at 1.155 million as opposed to 1,050. So an increase of stretch in the bands there by 10%. So that's great news. And then just as a reminder, if you withdraw from your retirement fund early, pre-retirement, you're taxed according to this table. And those rates have also increased by 10%. So good news on that front. And then another welcome bit of relief came through on the transfer duty tables and those adjustments. And again, we see a 10% increase coming through across the board here. So each band is stretched by 10%. So a property above the value of R1 million increases to 1.1 million rand. Below that value, you don't pay transfer duty. So that's our zero band of duty. And our top rate of 13% kicks in now at 12.1 million, whereas previously that was 11 million. So that change comes into effect for properties that are sold on or after 1 March 2023. So a welcome relief on that front. The fuel levy, no change. It's just interesting to see that if you have a look at the makeup there, and in that last column, you will see the 2023-24 rates. And general fuel levy, no change. Road accident fund levy, no change. Customs and excise levy, it's just the carbon tax levy that's gone up by 1 cent for petrol and diesel. So when you go to that petrol station, of the pump price, R6.17 if it's petrol goes to government, and diesel R6.03. Then a couple of the interesting incentives that came through, and the first one is the rooftop solar incentive for individuals, and again, it's part of the move to renewables and partly to solve the crisis at Eskom, and we see a theme as far as incentives for renewables, and this here is aimed at individuals. And the idea is to increase our electricity generation capability. The concern I've got, and Chris will probably touch on this later, is that we're taking, so these are citizens that at the moment are buying the electricity from Eskom or from the city, they will now move largely off the grid. So Eskom and the city are no longer getting that revenue. So as you move off grid, so the revenue of Eskom drops, and that equation becomes tricky. But at the moment, it's crisis management, and this is what's been put in place to alleviate the short-term problems. This incentive has come through in the form of a rebate and not a tax deduction. So a rebate is a credit that you deduct from tax payable, as opposed to a tax deduction that is claimed against taxable or against income. So the rebate is 25% of the cost of solar PVC panels, and capped at a maximum of 15,000 Rand. So essentially it reduces tax payable for the 2024 year, but capped at the 15,000 Rand. So what are the qualifying criteria? And again, the devil's in the detail here, so that will come through in the legislation. Solar PV panels must be purchased and installed at a private residence. Those must be new or unused, and it does not cover the cost of inverters or batteries. So that's an interesting one, because of course you can't run a solar PV panel without batteries. So that's probably a little disappointing, but it is what it is. And you require a certificate of compliance to be issued between 1 March 2023 and 29 Feb 2024. So you see the period here is for 1 year. So this really is short term. And the concern, I think, for me is that this legislation will only be promulgated very late in 2023 or early 2024. And the incentive runs out then. So some concerns, but I'm sure Chris can touch on those too. Then we see some movement on the retirement funds, and quite a significant one around trusts and beneficiaries of trusts. So we know the two-pot retirement system was imminent, was due to come into effect now. We were expecting that to be finalized. I think largely because the retirement industry is not ready. Their systems can't cope, and that's been pushed out to 1 March 2024. So some relief and some time to prepare. And the two-pot system, I'm not going to go into a lot of detail, but essentially it allows you to take your pre-retirement to take a portion of your retirement fund and withdraw. There's certain tax implications on doing that. And the change is that if you take out of your pre-retirement pot that accrued prior to 1 March 2024, that's going to be taxed at marginal rates and not according to those lump sum tables we saw. So watch out for that, and no change to the contribution deductions that we currently enjoy in terms of Section 11 Cap F. Non-resident beneficiaries of South African trusts. We know families are moving. The world is becoming a global playground, and families are dispersed all over the world. So a big concern here, and I suppose stemming from, and we shouldn't be surprised, stemming from the misalignment between the treatment of capital gains and income that are distributed by a South African trust to a non-resident beneficiary. And Para 80 doesn't allow that capital gain to vest in the hands of the beneficiary and be taxed in the hands of the beneficiary. It's trapped in the trust and taxed first in the trust at the trust's tax rate, in effect, a flat 36% on any capital gain. And then the beneficiary receives the after-tax amount. Income is different at the moment. Section 25 Cap B allows you to flow that income through to the non-resident beneficiary, and depending on its nature, is often not taxable in the hands of the non-resident beneficiary. And if it is taxable, SARS are battling to collect the tax. So what the proposal is now to align Section 25 Cap B with Para 80, and that means that the income distributed to non-resident beneficiaries are no longer, so the conduit principle will no longer apply. The trust will pay the tax at its rate, 45% flat, and the after-tax amount can go to the beneficiary. So not great news on that front, but watch that space. Again, proposals, so open to comment, etc., etc. Then, and I'm mindful of time, so moving on to corporate and business proposals that came through. The first one here is not a proposal. Of course, you'll recall last year that our rates of corporate income tax were going to come down from 28% to 27%, and those were for companies with years of assessments ending on or after 1 April 2023. So that's imminent, and our first year ends ending 30 April 2023 are going to be taxed at the reduced tax rate of 27%. And then, if you recall, the same thing was an adjustment, or the offset to that benefit was the limitation on assessed losses. And just be aware that that is in play at the same time. And you've got your 1 million rand, or the greater of 1 million rand, or 80% of taxable income there. Then another proposal that's come through that is most welcomed, and that's an extension of the diesel fuel levy refund system, and that is going to be extended to manufacturers of foodstuffs, and that's for a 2-year period. So that's most welcomed because, of course, they are chewing through diesel at a rate of knots on those generators. Another welcome extension is on the Section 11 Cap D Research and Development Allowance. And then a big one, Practice Note 31. That was to be withdrawn. That is one of the oldest practice notes around. And really what it does is it allows the deduction of interest against interest received, even if the taxpayer is not conducting a trade, and even if the interest expense is not directly in connection with the interest received. So that Practice Note 31 has been critically important, especially for holding companies, and in some cases, treasury operations within groups of companies. And really there was panic when the proposal was to withdraw that. A lot of comment came through, and so what Treasury have decided is to delay the withdrawal and look at rather an amendment to the law to kind of deal with that transition. So I think that's welcomed, but we'll see where that's going. Then no taxes in any of the, no change in any of the other taxes that you see on the slide in front of you. And I think I'm not going to dwell on that and go into any more detail there. Save to then just move on to the other kind of semi-highlight that came through. And that, again, on the theme of moving to renewable energies, incentivizing rapid investment in renewables. And that is around the Section 12 Cap B allowances. And those capital allowances that are accelerated capital allowances that are allowed in terms of the cost of those assets. So what we're seeing there is, or let's have a look at the current situation, is we can claim a deduction for renewable energy projects over 3 years. And that's a 50-30-20 capital allowance. And that applies to a number of renewable energy projects, except for PV projects below 1 megawatt. And those we can write off in 1 year. So 50, 30, 20, or 1 year at the moment, we are told that Section 12 Cap B is going to be expanded. And a deduction of 125% of the cost of all renewable energy projects will be allowed. And of course, this is for businesses, and there is no threshold on the generation of capacity. That's a huge incentive. Our R&D allowance at the moment gives us 150% uplift on spend. But this 125% uplift is certainly something. And we're going to see lots of movement in this space. And it's going to be interesting to see how some of the shenanigans is curbed here, because I have no doubt there are lots of people that are already devising schemes on this one. Then, importantly, this will apply for a 2-year period and brought into use. So it's these assets that are brought into use for the first time between 1 March 2023 and 28 Feb 2025 for purposes of trade and used by the taxpayer in generation of electricity. So that's that one. So thank you for putting up with that. We are now going to turn over to Chris, who is going to add some his perspective. And I know, Chris, you say you have got some slides. So I am going to stop sharing and you can go ahead and share.
Okay, does that show up?
Yes, that's perfect. You can just stick it onto slideshow mode.
Great. Just do that. Okay, thanks everyone. So I'll just maybe go through a little bit from a broader perspective first, and then we can talk a little bit about what we've done on the tax side, and I'll give some of our rationales for why we made some choices the way we did. Okay, so I think the main thing for us, and it's what the whole book is based on, is what we think is going to happen to growth. It's been revised up this year for 2022, for last year, sorry, to 2.5%, which is great. And you've seen some of that Dieter's gone through. It's led to an increase in revenue, which has been quite remarkable given the extent of load shedding and the number of days of load shedding. And yet industry have still put forward very good numbers and very good revenue collections from industry. So that was a good positive surprise from our side. I think the next year for 2023, this year, we had thought it would grow at about 1.4% in October. Now we've revised that down to 0.9, and then it'll be 0.9 rising to 1.5 and then going to 1.8. It's a bit of a decrease. So this does relate to the severity of load shedding. But it's certainly not as bad as the Reserve Bank's forecast. They went down to 0.3, 0.6, 0.9 for the next 3 years. So some people are saying, well, we're being a little bit positive compared to the Reserve Bank, but a lot of private sector economists actually have higher figures than this. So we're a little bit all over the place. I know the IMF also has higher figures for 2023. So it's quite interesting. I think what's that showing you is it's a very uncertain environment. With load shedding, with what's happening globally, inflation going up globally, yields on government debts in advanced economies going up. The Russian-Ukraine war is continuing. There's still some supply chain issues. Luckily, Europe didn't have a bad winter, so energy prices did come down. But inflation in some of the advanced economies is incredibly high. If you're in the UK, it's close to 10%. So it's quite an interesting environment, and a lot of us are not quite sure how it's going to translate into what happens in our economy for the year. The way we've looked at it, I suppose we think that some of the bigger corporates and bigger manufacturers have tried to insulate themselves from load shedding as far as possible. They've made the investments into alternative energy sources so they can actually continue with their operations even with long periods of load shedding, which has really shown the dynamism of our economy, which is quite a surprise to us as well, which is a great thing. So as Dieter was saying on revenue, it's looking positive. It's looking very good. Let me see if I can get a pointer or something. I'm not sure if you can see my mouse on the screen.
Chris, we can actually see your mouse.
Okay, good.
It's perfect, yeah.
Oh, good. Okay, so if you look just at what we like to always look at is what we call the buoyancy, which is basically it's just the change in percentage change in revenue over the percentage change in growth. So how does revenue react to growth? And in 21, 22, it was very high, 2.07, but that's more of a recovery from COVID. This year, 22, 23, I mean, the last year, the last budget, 2022 budget, we thought it would be 1.09, i.e. you get a little bit more tax than you would in terms of increase in growth, your nominal GDP. And then by the MTBBS, we thought, well, it's 1.3. Actually, commodity prices have continued to remain high. Mining still paid a lot more tax than we thought. And it was going to look very positive. And now we're thinking it's going to be 1.42. So it just keeps getting a little bit better. We have been very conservative in our forecasts. We've been assuming basically that the commodity price rally would fall away almost immediately. They shot up and they've led to great profitability with some of the mines, but it could very easily fall down again. And if it does, and now you've projected higher revenue, we've got to be very careful in terms of how we manage these budgets. Because if you project higher revenue across not only this year, but then across the 3 years going forward, what will happen in government and in the system is that while we've got more revenue, we can spend more. So then we can actually go ahead with some of the expenditure programs that you'd want to. But if those expenditure programs go ahead and that revenue doesn't materialize, then you can get into a very difficult situation. And suddenly you've got much larger budget deficits. And a lot of that happened in 2008-9 and onwards. It's a shame I don't have a slide on that, but basically when the global financial crisis hit, just before, we'd had a commodity price boom and revenues had shot up. And then we had this big increase in expenditure at the same time. There was the specific compensation for particular employees. They got this big jump in their wages for nurses, teachers, others. And then the global financial crisis happened. We had this big drop in revenue, but our expenditure remained high and we just could never get it down. And it remained high, revenue remained low. And then in 2015, we started trying to increase taxes to close that gap. Minister Mboweni always used to say the yawning mouth of the hippo, they're too far apart and they just stay apart and they just don't close. And then a lot of that really was from the commodity price gains running up to the global financial crisis. So we didn't want to make the same mistake again. We project very large revenue increases in future years from high commodity prices. You increase expenditure and then they don't materialize and then we're in trouble again. So we've been quite conservative, and then because commodity prices keep going, it's a fantastic surplus that you can then get, and we've had that over the last couple of years. And then you can see our buoyancy estimates for the next few years: 1.03, 1.1, 1.06, now it's 1.06, 1.06, 1.9. So we're trying to be relatively conservative in those out years, again assuming commodity prices fall away. But what it does mean is this tax to GDP ratio, which is at about 25.5%, is quite a high level for a developing economy. It's not a high level for compared to advanced economies. There is, some people always refer to this one IMF chart where they say South Africa is one of the highest taxed countries in the world, and that's completely false. It's really an incorrect chart. That chart excludes social security contributions from advanced economies. And because we have very low social security contributions, it's just the UIF and the skills development levy. It's really not comparable. They have tax to GDP ratios in the low 40s, some up to 50s. So 25, 26 is still quite high for a developing economy, especially on a per capita basis. But it's not more than the advanced economies. Although the other interesting part about our country is we've got very high personal income tax. And that as a contribution, as a percentage of total revenue, is much, much higher than even most advanced economies. So we rely more on personal income tax than even some of the very wealthy nations. And we're much, much higher than other developing economies. So we are unique in that respect. But here you can see, we think our tax to GDP will go up a little bit this year, and then it'll stay sort of flat, going up just a little bit, because we gave quite a bit of relief this year with 10.5 billion relief in fuel levy, about 8 billion in once-off VAT refunds because of flooding, SARS trying to pay down the credit book, etc. This tax to GDP ratio actually should have been even higher this year. And then we think it would drop a little bit and then slowly rise up again. This very big jump is quite interesting. And we do think a lot of that is due to SARS compliance. And I'm imagining, tax practitioners and others would know a lot better than we would about how well SARS is doing in their efforts to collect revenue. And we think that compliance effort has translated into additional revenue and has jumped this, led to a little step change up in this tax to GDP ratio, which is also very positive. And it's the story we try to sell to investors. This was the contributions of the different sectors. So as you can see, the red line is mining. And this is provisional tax payments, each year, 1 April to 31 Jan, sort of the data we had before budget. And you can see in 21, 22, there was this big jump because of this commodity price impact that we were talking about. And suddenly it contributed more than finance, all manufacturing. And it's gone off the boil a little bit, but it's still very high. I mean, the incredible thing here is how strong finance and manufacturing has been. Manufacturing was almost doubled in revenue compared to pre-COVID levels, which is quite remarkable. We do think a lot of those firms have spent time to improve their efficiencies, especially going through COVID, getting rid of the fat. And then now, as the economy has started to turn, that profitability has really increased from those efficiency improvements in the past. This is just a slide on expenditure. So, when we do the budget, it's not quite like your household budget, but it is really revenue on the one hand, expenditure on the other hand, and whatever the difference is, you need to borrow, and we get a gross borrowing requirement that my colleagues then go into the markets to borrow. So we had these changes in revenue that you've seen, but now what's happened on the expenditure side since the previous budget? So there are a few line items there. I mean, we've had to have a wage bill increase, and then that has to carry through to the outer years, you can see, and that adds, say, 15 billion almost each year. We're increasing infrastructure spending, and a lot of this additional expenditure really is because we've had a little bit more revenue available. So we tried to split, and I can't remember the exact split, I think it's 44-54 to additional expenditure, and the other has gone to reducing our debt. So we've been in quite a fortunate position, which I suppose should have reduced the stress levels within the team. There's also about 16 billion for service delivery, some to improve police, and some of the crime fighting institutions like the MPA and others. There's 36 billion that we've added for the 1-year extension of the SRD grant. And then this was a line item where we've increased social grants so that they can at least have an inflationary increase. This year, previously it wasn't in the baseline that they would get an inflationary increase. But now they have at least been increased to inflation. And then some other changes, and at the end you can see the change in expenditures about 37 billion, 42 billion, 49 billion. So incredibly, even with those large increases in expenditure, if you look at this very, very bottom line, this is what rating agencies, investors, everybody really likes to look at. And it's your primary balance. And your primary balance is the difference between your revenue and your non-interest expenditure. So it takes interest out, takes the the impact of your debt and the stock of your debt out of the equation. So you just look at your revenue versus your non-interest expenditure and see whether it's positive. And for the first time in a long time this year, we're going to have a positive primary balance or a primary surplus. So some people say, oh, well, then you've got extra money to spend on other things. It's not, because you've still got to pay for interest. But it's a good indication to then show whether your debt is increasing or decreasing, and whether in effect you are sustainable or not. So if you've got a primary surplus, it usually means that your debt should be going down. And if your debt is going down, you're in a much better position, and you probably will be sustainable. The main budget balance, this second last line, is what is the difference between your revenue and expenditure, including your interest. And unfortunately, as you can see there, we're still 300 billion down in this last year. Next year will be 275 billion down, i.e. our expenditure, including interest, is 275 billion above our revenue. And that gives you your main budget balance. So that will then directly lead to how much we need to borrow. So it's a great picture. And I mean, this fiscal picture has improved dramatically over the last 3 years since COVID. So we have been quite lucky as a country. But the main talking point this budget really has been Eskom. So Eskom is, there's a severe energy crisis going on. And Eskom has about, I think it was 430 around in debt, billion, which needs to be sorted out. So Eskom are paying a lot in terms of interest. They're having to do debt, capital repayments. And then if they're using all those funds, just to service their debt, they can't spend it on maintenance. They can't spend it on other projects that they need actually to reduce load shedding. So we really need to try and sort that out. So the plan here is we're going to give them 254 billion over the next 3 years. 168 billion in capital, 86 billion in interest. And the way we're going to do it is we're actually just going to borrow more and then transfer that money to them, and then they use that money to pay off their debt and interest as their debt matures. Because there was a big problem about having to go to every bondholder and renegotiate. But by doing it this way, we don't even have to talk to any of the bondholders. We can just say, leave them aside. There's no problems about potential defaults or cross default clauses or anything like that. We can just borrow the money, give it to them, let them pay off the debt as it matures, and you're gradually just shifting the debt from Eskom onto ourselves, all of us, the taxpayers. And then in the last year, there is going to be a debt swap of about 70 billion, and then that can be arranged. We'll have time to actually do that restructuring. So after all of that, if you look what happens to our gross debt to GDP, which is, I think one of the most important charts, you can see in the previous few years, it shot up from 48.5% in 2017-18 up to over 70 and 2 years ago after COVID. Dropped again to 68 because of additional revenues, and we really had cut expenditure. We didn't think our revenues would be so good. I think it was 193 billion above. Came up a bit. And then at the MTBPS, we thought we were going to just go down, but now it does go up for the next 3 years. But that's just because of this additional money to Eskom. And then once that additional money to Eskom is finished and that debt relief package is done, then we should hopefully drop quite quickly in terms of our debt to GDP. Problem is our debt service costs are still very high. So I see we don't have much time, so I'll just try and run through this quickly. Dieter spoke quite a bit about the tax proposals, but yeah, we're providing relief of 13 billion. Full inflation for personal income tax, the rooftop solar tax incentive, 12B, not adjusting general fuel levy. Maybe I'll just talk a bit about, I think there were some of the points you wanted to talk about. When was the retirement tax table last adjusted? I think it was 2014. So yes, it has been a very long time. I mean, the way we think about it, there were these big tax increases between 2015 and 2020. And we didn't adjust the personal income tax tables for inflation. We didn't adjust quite a few things for inflation. So we just adjusted. So we're assuming that doesn't really count. And then this is the 10% increases sort of to adjust for inflation from 2020 onwards. Which other one did you talk about? The rooftop solar. Okay, so we had long debates internally about this, batteries and inverters or just rooftop. This isn't the best incentive from a progressivity point of view. There's very few low income households are going to get any benefit here. So it's not very progressive. And if we are going to be providing a tax incentive to wealthier households, how should we do it? The thing is, with batteries and inverters, in our view, they don't help with load shedding, because most batteries that are used, well, we'll get to inverters because they're slightly different, but let's say just with batteries, you use the batteries to be able to have electricity when there is load shedding. So you're not adding anything to the grid. You're just using it when there is load shedding to then have your own electricity. And it draws down on the grid when it is available. Very few people sort of use battery electricity power when there is actually power available through the grid. So in our view, it wasn't adding to generation. It was in effect reducing the inconvenience of load shedding. And we didn't really want to provide incentives to reduce the inconvenience of load shedding. We want to do it to try and help with reducing the stages of load shedding, i.e. easing pressure on the grid. And the one thing that really does that is the panel itself. The panel itself is what eases pressure off the grid. And you don't need to go off the grid. You just need to be using the power from the solar. And because even if it offsets a little bit of what you should be using during that period, it'll ease the pressure on the grid. The inverters are very costly. So if you had any type of incentive, it would primarily just be used up in the cost of the inverter. And it's a fixed cost. You have to have an inverter with a solar panel. So, normally in economics, you never try and incentivize something that is a necessity, because if you have to get it, then everyone has to get it. So then, you'll be paying for something that there wasn't any choice on. So we focused on the panels themselves. We'll see how that pans out. But it really is to try and increase generation. So in effect, if you are a household with a battery and inverter already, in effect, it's, buy 4, get 1 free for solar panels that the government is doing. And then we'd really want to try and push people to put as much solar on as possible. I'm surprised people aren't talking enough about the 125% on the 12 cap B, because that was the one that we really think will make a big difference. And I hope there aren't that many schemes that you're talking about, but we really wanting to push this here. That's really where it should be at. The total energy used from residential households is 7%. The vast majority of energy use is from companies and industry. And if industry and companies themselves can use this big incentive to get themselves off the grid, it'll help employment, it'll help production, it'll help GDP. It would really be a strong story, in a strong way to try and ease ourselves out of this energy crisis, which we're trying to do. So that was the main one that we think should have the biggest impact. Perfect. And the diesel refund for food manufacturers is good as well. Sorry, I've got along.
Chris, sorry. Can I just, there are a couple of, there's a point that's been raised in the chat, and it is around the rooftop process. And you, look, as I said, the devil's in the details. So, it's now the question, and perhaps you can add some insight to this. So with regards to the solar rebate, is a private residence allowed to have 2-phase installation? So in other words, you put on 2 panels, let's say you put on 2 panels now, and you claim your rebate, and you put on 2 panels later and claim your rebate.
Your partner claims the rebate. So, we did also think about this, but it was going to be almost impossible to enforce. How do you do that unless you put in like a requirement that can only be per one resident? So at the moment in the FAQ and in the way we've done it, there is no restriction on that. So, you could, one person in a household could put up, get a rebate, another person could put up later, potentially get one. We haven't restricted it at the moment. It is sort of an emergency incentive that could potentially be done. I see some of the other points in the chat. Maybe should I just quickly try to answer them.
Perfect.
Being close to fiscal cliff. So there is this fiscal cliff study group that comes to Parliament every year. So I don't think we are close to fiscal. Our fiscal metrics are so much better than they were 3-4 years ago. Even before COVID, they're better. before COVID, we were only stabilizing at sort of 5-6 years, primary surpluses right at the end. Now we're already in a primary surplus. And if things don't get much worse, it should really be sorted out. So I don't think we are. But the only problem is global conditions were much better a few years ago, because interest rates were at almost zero in the US and in the EU. Now monetary conditions are a lot tighter. So even though we're in a better fiscal position, borrowing is still quite difficult. So our borrowing rates are still quite high. So we aren't close to it. But I suppose the Treasury officials should never say that we are close to it anyway. But I think we're okay. Would residential complexes qualify? So we put that in the FAQ. At the moment, they wouldn't. But we've said that if there was enough interest, we could consult on it and consider it, because it's quite a difficult thing to do, because everyone would have to pay, and then it would have to be allocated to each individual. What happens if somebody has paid a levy, but somebody else comes in? Do they get the incentive for someone else who's paid? So there are quite a few complexities there, and because this was sort of an emergency incentive, we haven't included them now, but we're happy to consult. What about the rental of solar? So at the moment, also the rental of solar isn't included. We were a little bit worried about, you can pay for a rental, but then if you stop paying, you've got the deduction, but now that same rental then can be used, taken off your house and used at another house, which might not be enough of a reason to not allow it. But at the moment, they're not included. How can we say only the panel essentials are good without the battery? So, yeah, that's the question that we've spoken about a lot. Because there are edge cases where someone says no, but they have a battery and they use it when there is actually power available. And if you use a battery in that way, you are reducing pressure on the grid. But we spoke to a few experts and a few people in the energy space, and they said, look, the vast majority of people don't use batteries that way. They use batteries to store power so that when there's load shedding, they can use the batteries. And that was why we didn't think it helps to the grid. Because if you use it when there's load shedding, the power, then you're not reducing pressure on the grid, because you're only using it when there's load shedding. So that was how we thought about it. I think I've answered some of the. Okay, I don't know if you've got any
I think
others.
hang on, sorry, there's one final one that's come through there.
Oh yes, I think that's similar to the first one.
Okay.
Yes, so at the moment there isn't a restriction on a per household basis. In the tax system, we don't do it on a per household basis. The whole tax system is based on an individual. And here we're saying it can be on any private residence. So it can also be on a second home, or it can be if you're a landlord on a house you're renting out. It can be at any private residence. So it was going to be a little bit too difficult to administer, but at the moment it is done individual basis. If you pay for rooftop solar, you can potentially get the benefit.
Okay, so someone's come up with a plan already to to get the benefit for both for both partners.
I know we did think about it, because we try and think about all these ways that things could be used, but you've got to think about, is it worth the effort of trying to police and then potentially undermine the incentive as a whole?
No, I can imagine. The response there, it's called genius. You guys have got such a difficult job. You look at any incentive that's put in place, there will always be those that come up with a scheme to abuse it.
I know, and generally we've been trying to get rid of them. And we've been quite forthright in a few previous budgets that we don't want incentive. But there are some cases when things are just so dire that you actually have to do something. I mean, it's only for a year to try and get people to do it now. So it's not as if we're going to have incentives forever. So I'm hoping that doesn't go against our main approach of trying to not have incentives because of these difficulties you say. I mean, it's difficult for SARS to administer. People find ways around it. It's not equitable. It's not simple. It's everything that is wrong with the that it goes against a lot of the tax principles of a good tax system. Anyway, thanks.
Yeah, excellent. Okay, Chris, I think we've just hit 10 o'clock and we've run out of time. But I think on behalf of all of us, thank you so much for your contribution. valuable insights and great to hear from the horse's mouth, so to speak. And yeah, enjoy a little bit of a break. I hope you manage to get some sleep over the next few days.
Me too.
Yeah.
Thanks very much, Dieter.
Excellent. Thank you, Chris. And then to our audience, thanks for attending. It was great to have you all, and hope you got some useful information out, and feel free to contact us if you need any help.